What's going on, ladies and gentlemen? Welcome back to Boss Blunt's Think Tank. I'm going to give everybody a minute to join in here before I get started. Just give people one quick minute to join in here to the live stream before I start talking about this. I have a feeling this is probably going to blow your mind. Some of this you guys already know. Other bits of this is new information. Let's just say that rate cuts don't always go very well, and they're usually done far too late. It's too little too late when the Fed actually decides to cut rates. Let's put it that way. What's going on, Paul, Colin, Rabbit, Robert, Ace, Comanzo, Felix? Ladies and gentlemen, welcome. There we are. Just dropping a quick note, a quick link to it in the Discord for everybody. Just dropped it in the think tank for you guys. Hey, Michael Jordan's Ghosts. Hit that like. Thanks very much. Destroy that like button, ladies and gentlemen. Hi, Kim. Welcome, my friend. Cheers, Joseph and Johnny. Thank you guys for being here with me. You can see here we have the entire history of Fed rate cuts to look at. And some of them are pretty rough, that's for sure. One thing to keep in mind about this, the rate cuts happening here, is there's not much runway for inflation before it takes off. Inflation's already much higher than it should be. And quantitative easing at this point is going to make inflation take off even harder. You know, it's going to increase the rate at which it grows fairly exponentially, if you will. What's going on, CRX? AD, what's up? It's good to see you guys. What's up, Jose? Good afternoon, my friends. Sean, when TMF? Should I even ask, man? Should I even ask what the fuck that means? When TLT? Ah, the inverse. The inverse to the bond market. TLT, TBT, TMF. I hear you. Dream the Stream says, we need a soundboard of boss saying, I want my fucking money. And the Cowboy Bebop song playing. That hard intro, I'd use that as my notifications on my phone all day. That's great. Paul Andrew says, the real inflation is way higher than what everyone is seeing. Man, you couldn't be more right about that. The real inflation rate is much, much higher than what people realize. And even worse, because it's cumulative. So people start seeing that inflation is coming down. That doesn't mean that the price of goods is coming down. It simply means that the price at which goods are going up is not as fast as it was last month. And that's not good either. You know, that's not good either. Michael Jordan's Ghost, they changed how they weigh certain things in the report and they removed used cars from the report. How? Yeah, a lot of people don't realize this, that the Bureau of Labor Statistics and the Congressional Budget Office constantly are readjusting the weight, and the Federal Reserve as well, the calculations of the weighting. So WEIGHT, weight. When they do that, it artificially makes the CPI and the PCE look to be accelerating less quickly, because literally they're taking the way it was calculating and reducing it. And that is like changing the math problem. CP lie. That's right. Darktown, Lady Kim, Sam. Cheers, friends. All right. Ready? History of Fed rate cuts. The market is pricing in a recession, guys. A 95.5% chance of a rate cut this September. And what does this mean? Basically, there's a 95.5% chance that there is a recession coming. 95.5% probability, according to the market right now. They're expecting 8 rate cuts within the next 12 months, or approximately 200 basis points. That is the most that we've seen since the great financial crisis of '08. They're expecting the biggest amount of rate cuts that we've seen since the GFC. And over the last half a century, closer to a century, over the last like 60 plus years, every single time that the market was seeing a 2% rate reduction, we saw a recession. These beige colored lines in the background indicate a U.S. recession. And the blue line is the 12-month forward market implied change in the federal funds rate. So when they're expecting rate cuts, the blue line is going down. And then the beige line is, of course, a recession. You saw that happen in 1971, 1975. Look at how far down the rate cuts were and the major recession we saw at the time. We saw that in the early 80s, the late 80s, the 2000 dot-com bubble. And every single time, the rate cuts, which means down, the rates are cut to the downside, and then the recession is exposed, or what is already a recession is then confirmed as a recession by the administration after the fact. Saw it happen in the 2000 dot-com bubble here and the '08 GFC. Matt asks, will a firm continue to rise or tank next year? Here's the thing about a firm and these buy now, pay later sites. As you guys are going to see, the consumer is fucking strapped. The consumer is tapped. Personal savings rate are at lows that we have not seen since the great financial crisis. That chart's coming up next. So that means buy now, pay later companies are going to be making massive profits as people, borrow money from them and have to pay interest rates. But as the recession continues and as the economy continues to deteriorate and jobs continue to be lost, there's a potential that the default rate, which is extremely high in credit cards and rising, for the buy now, pay later companies like a firm, increases even more and offsets a lot of those gains and turns them into losses. With these rate cuts now practically guaranteed, the best outcome, ironically, is the worst outcome for stocks, bonds, and crypto in the near term. Basically, we're looking at a potential market crash or a credit liquidity event that would lead to panic by the central banks. And it would lead to a powerful liquidity response in the form of quantitative easing, which would lead to the strongest market rebound after the first cut around 3 months later. And the market knows this. However, this directly leads, again, you see the dominoes, right? One thing leads to the next, to higher inflation. So we are, in my opinion, and I will show you exactly why through these charts, going to see rate cuts, market deterioration with a potential crash, collapse, or liquidity event, panic by the central banks, greater rate cuts, quantitative easing, the printing of money, which would lead to the stock market rebounding, bonds rebounding, crypto rebounding, and then inflation following suit. October 1973, we saw a 44% downturn. 44% downturn in the market within 12 months after Fed rate cuts. January of 2001, 28% downturn in the markets 12 months after the rate cuts. 2007, 24% downturn. 2019, 25% downturn. The difference here is today, guys and girls, pay close attention. The difference now is that inflation is much higher than it was in 2007. It's much higher than it was in 2019, and it's way higher than it was in 2001. That's not a good sign. The Federal Reserve, the American economy, the consumer, is caught between a rock and a hard place. Again, here's a different, more zoomed in view of 1981. The black line are the rate cuts. Down means they're cutting. And what happens after that? Recession. The recession. Again, here, they cut in 1990, and then 91, recession. Sorry, excuse me here. The green line signals, the green vertical line signals the rate cuts on this chart. The black line signals the 10-year over 2-year yield curve inversion. And the red line is the recession. Excuse me for that. But the same thing applies. The inverted yield curve, the rate cut, and then the recession. And then the yield curve uninverts. The inverted yield curve in black in 1990, the rate cut in red, and then the recession continues, and the yield curve disinverts. And the same thing happened in 2001 when rate cuts occurred. Same thing happened in 2007. Rate cuts is the green vertical line in the middle, followed by the massive recession we saw there, the printing of money by the Federal Reserve. The disinversion of the yield curve is the black line going up, and inflation increases. The difference now is that inflation is much, much higher now and stickier and long-term trend-wise than it was in any of these other years. In 2019, same thing. As you can see here, Brett says the 10-year over 2-year yield is back to the zero line. The inverted yield curve is one of the most accurate recession indicators. There's a black line. You can see it right there, right at the end here. This says September 1st, 2024 is the expectation for the Fed rate cuts in the month of September, of course, not necessarily the 1st of September. The longest inversion prior to 2022 was 16 months. 16 months. What we're seeing right now is completely unprecedented. Okay, Matt, I can't say if it'll be a bloody Tuesday next week because it's not going to be like a one-day thing necessarily. But I will say I am holding SPY puts. The SPY is ripping and roaring, and it is VIX Crush Friday today. The volatility on the SPY is being absolutely crushed. The volatility on the VIX is getting crushed purposely by market makers and hedge funds and central banks. And this is done in large part by the United States Treasury via the usage, via the tactics taken, I should say, by Janet Yellen. Now, Janet Yellen is the head of the plunge protection team. And as the head of the plunge protection team, they literally sell naked shorts on the VIX. Selling naked shorts on the VIX leads to a gamma ramp and delta hedging in the SPY and in the S&P 500. So they're forcing high-frequency traders and algorithms to buy the SPY to hedge versus their crushing of the VIX by selling naked shorts on it. And this is indicated clearly by the fails to deliver by the United States Treasury, which I'm not going to go into now, but you can look that up yourself. You can literally Google FTD's U.S. Treasury, and you will see exactly what I'm talking about. I'll show that on the next stream. Check out credit card defaults. This is the year at the bottom, March of 2000. Look at the way that they started to trend upwards. Again, March of 2009 in the center. Look at the way they started to trend upwards. (2020), the reason that credit card defaults collapsed was because people received a shitload of money and banks received a shitload of money directly from the government. And they used that to pay off their bills. Now, the government's already printing a shitload of money, but they're sending it to countries other than the United States, and that's leading to higher inflation. And it's artificially increasing the GDP of this country because the printing of money and the government jobs that are being created artificially inflate the gross domestic product of the United States. Now, I say artificially because it's not consumer spending, it's not growth in the economy, but it is literally jobs created by the government to inflate these numbers both employment numbers and GDP numbers. And then the printing of money also is added directly to the GDP. So these are artificial numbers. And as you can see here, beginning in 2021, 22, basically, the default rate for credit cards is rising. Let's see what they said here. This is the case for all age brackets, especially the younger ones. The 18 to 29 bracket is at the highest level that it's been in 10 plus years. The millennial is getting destroyed right now. This is worsened by more than $1 trillion in credit card debt, and that's an all-time high for those of you guys that don't know. Credit card interest rates are hitting 21.51%. Something is bound to break, says Game of Trades, and I do have to agree with them on that. They continue to say that high rates and rising costs are putting a lot of pressure on the consumer. The market uptrend remains intact for now, but we'll be booking profits and rotating capital when the bullish structure breaks. So cheers to Game of Trades for that. Good post. Now, this is a lot of what we were talking about just moments ago, guys. And yes, the dudest dude says this was inevitable. This was exactly inevitable, my friend. The real estate market is weakening. I'm going to go into that next. But as we talked about at the beginning of the stream, the PCE and the CPI are just that. They're lies. The Federal Reserve is constantly changing the weight distribution of the calculation of the basket that makes up the CPI and the PCE, and therefore artificially reducing the CPI numbers. This makes CPI appear to be going down. It makes inflation artificially look to be weakening when in fact it's flat or higher than it was before. July PCE inflation, the Fed's preferred measure, was 2.5%, slightly below the 2.6% expected. Core PCE was 2.6, below the expectations of 2.7. They were flat compared to June. A September rate cut is on the way, they say. We continue to see all inflation data move in the right direction. However, we also believe 50 basis point rate cut is too aggressive. We expect a 25 basis point rate cut at the September meeting. I agree with the 25 basis point rate cut coming this September, but I think that that is a big mistake by the Federal Reserve. They should not be cutting yet because, as we just discussed, they changed the calculation of the weights of said inflation in order to make it appear as if it's being reduced or flat, and that's not the real facts. Let's talk Bidenomics, ladies and gentlemen. That is very clear right now. David says this was planned, and you're absolutely right, my friend. This was a long-term plan by the Federal Reserve and the United States government to destroy the middle class and the 99%, to reduce their debt load via the amount of interest they have to pay. That is the only thing that inflation is doing. The U.S. government dramatically underestimates the real rate of inflation, says Wall Street Silver. Of course, I just got done telling you that, and you guys know that. The government does this intentionally so that they can minimize the cost of living adjustments to Social Security payments. If CPI is faked lower, the government can steal more from Social Security recipients. Another valid point that I had not thought about. I explained to you the way that CPI is manipulated in order to help reduce the amount of debt owed by the government, even though it's constantly growing every day by the tune of $1 trillion is being added to the debt of this country every 3 months by the Biden-Harris administration. Every 90 days, every 3 months, another $1 trillion in debt. Another $1 trillion is printed. Over $10 trillion has been added under Biden and Harris alone, which is a record high. A record amounts, a record high, a record over 4 years, a record every 3 months, a record every day. I think you get the idea. Looking at the source from Grok, artificial intelligence, and I think a lot of you will agree when you look at your grocery prices, guys. Orange juice over the last 4 years is up 43%. Eggs are up 100%. Ground beef, 40%. Rice, 50%. Lettuce, 50%. Potatoes, 50%. Milk, 50%. Bananas, 50%. Cheerios and bologna, 43%. Fucking soup, up 50%. If I look at my grocery bill, I'm paying double what I used to pay 4 years ago. I have a family of 6. What used to cost me $800 a month to feed my family, $200 a week, is now costing me $1,600 a month. Me personally, to feed my family of 6, I have to spend between $300 and $400 every single week buying reasonably priced food from places like Aldi and Walmart. I'm not talking about going to Sprout or Whole Foods. I'm talking about going to reasonably generic brand food, not buying ribeye steaks, not buying high-end food is costing me $400 a week, every single week. And that number is rising. Literally 4 years ago, that number was $200 a week. And I think you guys can even say that. Look at ramen is up, even Arizona tea. You guys remember when you used to be able to buy 10 ramen, literally like Maruchan for $1, 10 for $1? You remember that? Those days are long gone. You cannot do that anymore. Oh, here's the credit card defaults that we just spoke about. Wrong one. Switch this up. Check this out, guys. Hey, Bitcoin Stu. Good to see you, my friend. Black Widow, David. Cheers. For the YouTube says shop at Publix, BOGO, and Walmart. Yeah, man. Like you do what you got to do. You go to the most reasonably priced places. I'm going to Kroger, going to Walmart, going to Aldi, things like that. And I got no shame in it. I'm more than happy to try to pinch pennies to try to get ahead in life. But at this point, for a lot of people, it's pinching pennies just to be able to survive and skipping meals just to be able to survive. And this is directly correlated to the ability to pay for your mortgage or pay for your rent. The typical home buyer, says Kobasai letter, the down payment has risen almost 15% in the last 12 months to a new record high of $67,500 for a average down home payment right now to be able to buy a house. $67,500. This is up from $58.7 last year, and the 12 straight monthly increase. 12 straight months increasing. This is also more than double the pre-pandemic average of $30,000. So before, 4 years ago, basically, people were able to put down an average of $30K to buy a house. That number is now more than doubled, is up over 120% to $67,500. The reason being, because if people don't put down this much money, they will not be able to qualify for a mortgage. And even still, as I'm about to show you in the next chart, people still can't afford to buy, and new home sales and existing home sales are getting crushed because of it. Thank you, Nat. Appreciate you. Hey, Spy Hunter, welcome, my friends. Crazy Carl says the BlackRock CEO says the 99% should just work longer. Ain't that the truth, my guy? Ain't that's exactly what they think. Over the last 4 years, the median down payment is now up a massive 167%. Sorry, as you can see, I'm not reading what they're saying here. I'm giving you my opinion on it. And my off the top of my head math, I said around 120% was wrong. The median down payment has increased up to a massive 167% from $25,300 over the last 4 years to what is now $67,500. The typical down payment on U.S. home could be seen past median household income. This is truly remarkable. Absolutely right. David Brady, global pro trader. Check this out, guys. Home buying conditions hit record lows, according to the Michigan Consumer Sentiment Survey. This is the University of Michigan. Home buying conditions have hit a record low, greatly exceeding that we've seen during the GFC, greatly exceeding the dot-com bubble, and even the 1980s recession and stock market crashes. Home buying conditions are at a place in history that has never been seen before. Never been seen before. It has never been so hard for the middle class to buy a house. Now you're asking, why aren't housing prices going down much? Only in certain areas, right? It's very based around neighborhoods. For example, if you look at places where there's a lot of new homes and new home constructions over the last 10 years, Texas, Idaho, Florida, home prices are coming down. If you look at places where there's not a lot of new construction, like up north and in the Midwest, Northeast and Midwest, home prices are still slightly going up or about the same. This is because there's still not enough supply up there to compete with the amount of institutional investors like BlackRock that are buying up the currently existing homes. Therefore, they are artificially elevating the price. Not to mention, the Federal Reserve has over $7 trillion worth of mortgage-backed securities on their balance sheet. That's not millions or billions. I'm talking $7 trillion worth of artificially increasing the price of the housing market at this very moment, guys. The University of Michigan current party conditions. As you can see here, according to Republicans, the current conditions have never been worse. And I don't care who you are, if you're on the left, if you're on the right. I've never voted for Donald Trump before in my life, but I will say that as the Biden administration, the Biden-Harris administration, and the deep state and the World Economic Forum have moved the goalpost 100 yards further to the left, other people that formerly considered themselves as being on the left, such as myself, are now considered centrists, or even, by some of the far left radicals in the DNC are being called far right. The reality of the matter is that the majority of people, the 80% of Americans and Europeans and, other people around the world watching this right now, are neither left nor right. They're kind of centrists. Live and let live. You want to do your thing, do whatever the hell you want, just don't bother my family kind of thing. And I respect and I appreciate that. We don't want to take away people's rights naturally. You want to get married to a he, a she, and it. Nobody cares. Do your thing. Enjoy yourselves. But the fact that a lot of people no longer align with that, with the DNC, is because they've taken the goalpost and moved it 100 yards further to the left on the football field, and everybody else has stayed in the same place. So as you can see here, according to Republicans, current conditions have never been worse. And I say that because I'm talking about people that are not sitting on the Democratic Party. I'm not talking about you or me or anybody else. I'm talking about people that are in the DNC, are obviously, trying to get Kamala Harris elected. So they're not going to agree that the current conditions in the economy are bad. Whereas Republicans are seeing things a little bit more from a perspective of the everyday American, I would say. Stockton says, in Jersey, prices are way up. My house 10 years ago for $328, my neighbors are selling for $800 and $900K. Yes, sir. That's right. Again, and that's due to the $7 trillion worth of mortgage-backed securities by the Federal Reserve. Savings rate is at a record low, and the credit card debt is at a record high. This is a massive indication of a recession. Massive. Every single time that this has happened in the past, it has been directly related to a recession, a market crash, and many other things just like that. Record high unemployment. Overall, not good for the average consumer, not good for the average global citizen. The savings rate is at record lows right now. It's at 2.9%. And even before the pandemic, that rate was around 7%. So pre-pandemic, we were at 7%. Now we are, at less than 3%. The credit card debt pre-pandemic was around $18 trillion. Sorry. Yeah. Taking a look at this here. Credit card debt is at, sorry, not $1 trillion. I was looking at the savings rate record low. Was at around $1 trillion, just shy of it, closer to like 800 billion. Currently, credit card debt record high of $1.34 trillion that we're seeing right now. That's the red line here, indicated by the red numbers on the chart on the far right. Staying on that topic, look at the personal savings rate. Zero Hedge says the consumer is done. The savings rate is the second lowest of the post-QE era. And by QE era, he means from the 2007 GFC, 2008 GFC through today. The personal savings rate is less than what is pre-pandemic. It's less than it was before or after the pandemic, before or after 2019. And it's even worse than it was before the government started printing trillions of dollars in 2008 to kick that can further down the road. I hear you guys. GME is doing work today, up over 9%. I'm not writing home about it right now. I'm looking forward to seeing AMC, GameStop, and many other meme stocks, heavily shorted equities, silver and gold, skyrocket, but that day is not today. U.S. consumer credit card debt and U.S. personal savings. Credit card debt is in black. U.S. personal savings is the blue line, and the green filled in portion is the difference between the two. Look at what happened in the difference between the blue line, the U.S. personal savings from 2007 to 2009. Credit card debt ballooned because people had no savings. What happened in 2008? The government started printing trillions and trillions of dollars. And this artificially inflated our economy, artificially inflated home prices and jobs and so on, and led to a bigger boom. Again, in 2019, we had another, 2019, 2020, we had another recession there. And you can see the personal savings rate was getting crushed again before the money printer came out from Jerome Powell, bailed out the banks, bailed out the American taxpayer, and created the ridiculous inflation over, or began the trend of creating the ridiculous inflation. And as that petered off, Biden-Harris administration took over in 2020 and turned on the money printer to a level never seen before. They also completely eliminated the cap on government spending and are now printing $1 trillion every 3 months. That has led to the inflation that we're currently seeing. This is purposefully being done to destroy the middle class. And the U.S. personal savings rate, as you can see, went from over 25% in 2021 when they printed all that money to less than 3% today. In contrast, the U.S. consumer credit card debt is greatly elevated, and the next thing that follows is a pink line that should have already started being drawn. As you can see here, look at the 2007 to 2009 bars. The credit card debt in 2008 peaks way before the recession, or way after the recession already started. So the pink recession was already in full swing before they actually put that bar into there for 2008 and 2009. Same thing we're looking at now. Credit card debt peaked. The recession started already last year, if not 2 years ago. Later on, they'll come back in and put in that pink line after the fact, after the Biden-Harris administration is no longer allowed to manipulate those numbers. And we will see that we've already been in a recession since the beginning of 2022. And what happens next? The money printer comes out. The market crashes, I should say, first. Then the money printer comes out. Then inflation becomes elevated. After the stock market starts going higher, right? House prices start going higher again. The stock market leads the way for inflation through the QE that's going to come. Consumer sentiment. What the hell just happened? Oh, this is not a chart. It's an article here. Again, University of Michigan consumer sentiment is at levels not seen in quite a long time here. And I can't see the numbers there, but I'm guessing that's going to be 08, and it should be pretty clear since 2022. That's the lows that we saw in 2022 when consumers were looking the stock market correction in the eye and starting to realize that something is seriously wrong here. Scott brings up a great point here. He's the executive VP of Curvature Securities and has written a book about the repo market, shorts, shortages, and squeezes. And I wanted to say he put up a series of tweets in which he brought up some great points. He said the overnight repo rates open high and close extremely soft, trading as low as 5.1% over the past 2 weeks. There are several factors causing the dislocation. It's the end of the month. There's often pre-month end funding pressure, so this could explain the funding pressure in the morning. And I want to tell you guys today that, as you can see here on our think tank, the reverse repo operations today were at extremely elevated levels. They were yesterday. The reverse repo traded around $330 billion, and today the reverse repo operations were up $100 billion. Yesterday, 69 counterparties is up to 72, and they traded 433 billion in order for these banks to cook the books for the end of the month, because it is the last trading day of August. That's what Scott Scarm here is stating in terms of the month end. Leverage. Clients are more leveraged. We receive constant inquiries from clients to fund additional long positions. Asset allocation. When investors have large cash allocations, liquidity comes into the repo market. We just said exactly why right now. Bank reserves. When excess reserves in the banking system become tight, there's funding pressure and it leads to funding volatility. For example, September 2019. For those of you that are unaware, September 2019, September 19th, to be specific, of 2019 was the day that the repo operations began to crash and collapse, and that rate skyrocketed from 5% all the way up to 12%. No banks were lending, and the Federal Reserve was forced to step in to save the bond market and the repo operations. They took over repo operations that day and started the daily reverse repo and repo operations that we see today, inflating at one point money market funds up to $2.55 trillion in overnight bailouts, trading back and forth between these money market funds and the Federal Reserve, exchanging U.S. treasuries and other securities in the overnight reverse repo market. I won't get into that much more so right now. If you haven't seen my other videos about that, I'll talk about the reverse repo in the next video more in depth so you can better understand that. But the balance sheet runoff, the issuance, balance sheet runoff means, right, obviously they're trying to reduce their balance sheet. At least they were before the Federal Reserve turned tail and decided that they could no longer do that. The balance sheet runoff and the treasury issuance add securities supply to the market, and they drain cash. And that's what's happening with the United States Treasury. They're using the money in the 2.55 trillion is now down to 430 billion over the last 12 months, basically because the United States Treasury has no country in the world, not no country, right? But there are very few countries in the world, comparatively speaking to the past, that are willing to buy U.S. bonds and treasuries right now. So they're using our very own money through mutual funds, hence the MM money market funds. They're using our mutual fund money to prevent the yield curve from staying inverted, and they're disinverting the yield curve by buying up U.S. treasuries and bond note issuances from them using that money. So hence that's why it's down from 2.55 trillion to 430 billion today. And I can guarantee you that on the first trading day, which I think will be like September, the day after the holiday, will be on Tuesday, you're going to see that number go from 430 billion today. That will be at 330 billion or less on Tuesday, because they won't need to be cooking the books because it'll be the first of the month. Money market funds. Cash in money market funds is estimated to have increased by 90 billion during the first half of August. He is correct, but that also decreased from 2.55 trillion to only 430 billion today. The current 10-year was issued on August 15th. There will be a reopening that settles on September 15th and a second reopening that settles on October 15th. During the first 2 weeks of September, once the reopening is announced, but before it settles, the 10-year can trade very special in repo. The current 10-year already has a good bid. The repo market knows rates could start going lower on Tuesday. The date, 9/15 term market rallied from 5.12 today to 5.08% beginning tomorrow. Let me check this out. See when September rate cut date would be September 18th. If that occurs, right? But that's what we're looking at right now. And I'm pretty sure it will, because I think they know that things are broken. Even though I don't think that they should, the Federal Reserve should not cut rates. Spy Hunter, so what's going on with those carryover swaps with the yen or something along those lines? My friend, that's a video all in itself. Let's talk about that in the next one. The carry trade is on hold right now. Listen, let's put it this way. Regarding the carry trade, what you guys saw last month with the Japanese carry trade that was crushing our market and crushing the global markets, if Japan raises interest rates or if the United States lowers interest rates, they will have the same effect. The arbitrage difference between the Japanese yen and the US dollar carry trade will be significantly reduced. That means that the money that they're making could potentially turn into a massive loss because of the crazy amounts of leverage. Therefore, rate cuts could very easily, and in my opinion, will very easily lead to a very quick short-term downturn in the S&P 500, the Japanese markets, and in global markets, period. Hey, Sky One says AMC might go under. Your stocks will be worth zero. Womp womp. I think you're a fucking idiot, but hey, to each his own, my friend. You do whatever you want, Sky One. The market is not pricing a big CTD squeeze on Thursday and Friday, but with month end, you never know. No, I do not think that's the case. Scott also says that as soon as September begins, securities that are eligible to be delivered for the September Treasury futures contracts will be delivered to the exchange. Most popular contracts are the 2-year, 5-year, and 10-year. Look at the rate of return there on the 10-year. Why take 4.6% over 10 years when you can get 4.3% over 5 years? You know, and he missed the 3.87. He missed the 3 here on the 2 years, it looks like. But I'm not sure if he copy-pasted this or if he just mistyped. Oh, it's 0.875 over the 2-year futures. So no, he's correct on the 0.875 basis point coupon for the 2-year no futures. He says will be rushed on the first eligible day, September 3rd. That means traders will be boxing the securities beginning Thursday, and there could be a shortage in the repo market on Thursday and Friday. As I showed you guys, no shortage in the market here, but specifically related to the fact that it is the end of the month. The banks must cook their books. So, what's going on, everybody? Zachary, Luke, ladies and gentlemen, welcome back. I want to say, look at the drawdowns that we've seen in the 12-month period after rate cuts. 1973 does not compare to what we have today. The numbers that you're currently seeing have been falsified to a degree at which they can't even be trusted. And I think you need to do your own due diligence. Take a look at the things happening around you. Take a look at the people around you that you know. How many people are beginning to default on their credit cards that are even willing to talk about it, because a lot of people aren't willing to talk about that. Default on their homes. Are foreclosures going up in your area? How long are homes sitting on the market? How are jobs? How many of those job listings have you applied to that have not replied because they're ghost listings? They're not real listings. Please make sure that you are doing everything possible to hedge yourself against this inflation and against this recession that at this point is completely inevitable. We are already in the recession, but it will not be noted or accepted by the current administration. That is something that the coming administration will have to do, and they will respond to that by printing a shitload of money, and in return, that will lead to higher inflation yet again. We're in for a lot of volatility in the long term. Make sure you're properly hedged, ladies and gentlemen. I will leave you with that. I wish you peace and wealth. Have a great weekend. But you know what? I'm not done there. In 1 hour, we will be hosting my friend Wolfie and, what's becoming my friend Mark Falk here, who is the producer, actor, and writer for the upcoming series or film called The Financial Terrorism in America. He was an associate producer and writer and actor in the movie in 2009 called Wall Street Conspiracy. If you haven't seen it, you can check it out on my channel, or you can go to just Google the Wall Street Conspiracy and you can find it on YouTube for free. It's an amazing film and you're going to learn a lot. But join me in 1 hour and we will have him on the channel yet again. We had him on the channel here on Monday, and he's back with an update. We got good news on the situation and the series itself. Broke Ape says, does the SQQQ Commons excuse me, does the SQQQ Commons still count as a hedge? The SQQQ is, for those of you that don't know, a leveraged inverse to the triple Q, which is, basically ETF of the NASDAQ. And the SQQQ is an inverse to that ETF. So if the NASDAQ goes down, the SQQQ will get leverage on that. Yes, I would say it is. However, if I recall correctly, I believe it's one of those exchange-traded products that cannibalizes itself. So I would be personally hesitant to hold the SQQQ for a long period of time. However, that does not mean that the potential for growth or very quick, fast, rapid growth on those SQQQ is not there, especially in terms of in times of massive volatility or in times of massive market correction. In my opinion, holding long-term calls on the SQQQ, which again is the inverse to the NASDAQ, inverse to the QQQ ETF, I should say. Long-term calls, something in the form of leaps, 12 months plus out, may not be a bad idea. But again, this is not financial advice. I'm not a financial advisor. You should hire one and do your own due diligence as well. Sky One says, put all your money in AMC then. Sky One, I have 6 figures in AMC and GameStop and silver and other precious metals and highly shorted equities, and I feel very strongly about them. And even though they are down from their all-time highs, that is no surprise, because anytime there is a run for these stocks and equities that is over 2,000%, naturally they are going to have a period of correction, or at least a period of massive naked shorting and shorting that artificially brings them back down, because as many of you may or may not know, market makers like Ken Griffin has stated in the past that, quote, we set the price of securities to what we think they should be valued, end quote. Meaning that they naked short the shit out of stocks and precious metals because they want to. And it's legal for them to do so with the market maker exemption 203BI. Anyways, that being said, eventually all shorts must cover, all shorts must close, and I'm not fucking leaving. Cheers, my friends. Have a great fucking day. I wish you peace and wealth.